the topic which you have in your syllabus is income tax law and practice, also commonly known as direct tax law and practice. The name is the same. The first module is introduction to income tax. So what is actually income tax? Income tax is a tax or a levy which has been charged by the government on the income that you earn. So tax is a compulsory extraction. It is something which is not voluntary to be done. It is something which you have to compulsorily pay to the government. It is collected from the people by an authority. The authority is usually the government which is there. In India, it is governed by the board which is called as the Central Board of Direct Taxes, controlled by the Finance Ministry. So every year on a yearly basis, the assessment is done with respect to each individual's income ability, and that is actually collected and that tax is collected by the government. So as you see here on the slide, you would be able to see it is taxes are imposed by the central government. Why central? Because it is direct tax. Direct tax is usually collected by the central government, and whatever revenue that is being collected by the central government would be shared between the states also. It is the duty of the people to pay taxes. So you are duty bound to pay your taxes to the government, and it is a right of the government to levy the tax on the citizens within the country, and that is how the public expenditure of the government actually works. Okay, so the objectives of taxation, keeping all these things in mind, you would be able to say it is a generation of revenue needed for the government. Government requires revenue in order to meet the public expenditures, like for example all your infrastructure, your roads, dams, irrigation projects, all these things have to be financed by the government. And where do they get the money from? It is from the taxes that you generally pay. So it is a prevention. It is another objective is the prevention of concentration of money in the hands of a few. So in order to have equal distribution of money among the people, it is required that you have to collect taxes. So how do you say that there is an equal distribution? More you earn, more taxes that you pay. In India, we actually follow a slab system of tax. You all know that the more you earn, you would be able to pay a higher, the higher would be the rates. We have different slabs which is there, which we will discuss later on. It is also the objective is to increase the habits of savings and productive investments by the people. So there is two terms which are there in that particular thing, habit of savings. Because since for example, your income is X, your expenditure is Y. In expenditure also there is a component which is called as tax. So whenever you earn income, you are very conscious that you will have to pay the taxes by the end of the year. So there is inculcating a habit of savings among the people. So people will know that they have to save because they have a stipulated amount of money that they have to pay as tax. So they generally have a habit of saving. And tax also has a component which is called you have the options of investing in various different sectors which government gives you deductions. So automatically people will have that particular habit of creating savings and then probably going for productive forms of investment. Then there is a speedy economical development. More and more revenue has been collected by the government. The government would be able to invest that particular thing in various different infrastructural projects. It will be able to generate employment opportunities. So these are the basic. I'm not saying that this is a conclusive list. Some of the major objectives which you can find out of taxation. Why government has to collect tax? What is the need for collecting tax which is there? So if you look at the classification of tax, we have two components. The topic which you are learning right now is direct tax, which is on the left side of the slide. On the right side, you will see indirect tax also. That is something which is related to what right now it is also called as GST, the goods and services tax. So we will concentrate on the left side of the slide. The direct tax, the impact and incidence on the same person. That is, you directly pay the tax. The incidence of tax is on you. You pay directly. If you look on the right side, you will see impact and incidence on different persons. Because you buy a particular commodity, you pay your GST for example. You pay to the shopkeeper will automatically pay to the government. So there is no direct incidence. That is why it is called, the incidence falls on different people which is there. And that is why the name is indirect tax. Look at the second point, no intermediary between the government and the taxpayer. You yourself will pay the taxes directly to the government, and that is why it is called direct tax. Whereas in the indirect tax, there is an intermediary. As I told you, the shopkeeper, for example, is an intermediary. You buy the commodities, you pay your GST or your tax to the shopkeeper. The shopkeeper will ultimately pay it to the government, which is there. Example is income tax as well as GST, which is there. Direct tax laws in India, if you look, these are the various, and right from the time before independence, we have direct tax laws which are there in India. 1860 onwards, you will find in 1962 the income tax rules, 1961 the income tax act was passed after the independence. So 1947, if you see, the business profits was enacted in that particular time period when we got the independence. And later on, if you see, in 1961 the direct tax code which came into practice, whereby you have the 1961, you have the income tax act which was coming, as well as you also have the income tax rules which were also framed in 1962. Now, if you look at the charging section of income tax, you will be able to see section 4 of the Income Tax Act 1961 gives the power for the government to collect taxes. See, government should be empowered to collect taxes from you. So it is something which, as we have learned in the first slide which was there, it is a compulsory extraction of tax from the public. We have learned that particular thing. So if somebody has to compulsorily take tax out of it, there should be a rule or a law relating to that particular. So section 4 of the Income Tax Act gives the power for the central government to extract taxes on the income that is generated. The income tax is an annual tax. You pay it on an annual basis. Income tax of the previous year is taxable in the assessment year. For example, the assessment year right now is 2019-20. You will be paying taxes for 2018-19. Okay, so that is usually the practice. That is, whatever income that you have earned, you will pay taxes in that year itself, but at the end of the year, and next year you will be assessed to the tax of the previous year. So it is always, you have 2 years in consideration and any particular financial year if you learn. The 2 years are called as previous year and at the assessment year. Your tax is paid for the previous year and you are assessed for the tax in the assessment year. And the Finance Act passed by the Parliament fixes the tax rates. Every year you will find changes in the tax rates which is there. It is, as you know, every year the Finance Act is actually been passed by the Parliament while the Finance Minister presents the Union Budget. The Union Budget is presented before the Parliament as a finance bill. What is a finance bill? It is the income and expenditure of the government. Okay, so that is actually tabled before the Parliament, and the Parliament passes that particular thing, and there how that finance bill will become a Finance Act, and it would be envisaged on the people, or it will become active on the people, and whereby the people will pay taxes according to the rates that is being. So this particular flexibility is there in the Finance Act, whereby the government can actually bring about changes in the income tax rates which is there. As the government feels that it requires more money for expenditure, the government will increase the rates, or when the government feels that there should be some deductions or reductions should be given to the public, government will change that particular day. It is something which is very flexible. Tax is charged on the income of every person as defined under section 231. Section 231 will give the definition of persons which is there. Who is a person? Who are all liable to pay taxes? Okay. And tax is charged on the total income of the particular assessee. You will have several different sources of income. That is, you will be earning your income through your salary, that is regular emoluments. You will also have income from house property, for example. You will have your houses which has been let out. You will have some sort of business, for example. You can have businesses also. So you will be paying your taxes based on the total income from all the heads which is there. Okay, and wherever possible income tax must be deducted at source. There is something which is also a topic which you have to learn and understand, which is generally called as TDS, that is taxes deducted at source. Okay, so that is there. The gross total income is defined as per section 80B, that is all the incomes that you earn in a particular year is totaled up, all the heads, which are all the 5 heads which is there: income from salary, income from house property, profits and gains from business or profession, capital gains, and income from other sources. So all the heads together, whichever is applicable to you, you will total that particular thing, and the resultant figure is called gross total income, the total of incomes of the assessee from various heads of income before making deductions under chapter 6A of the Income Tax Act is called as gross total income. The total income, after gross total income, you will have provisions to deduct your deductions, that is all the eligible types of investments etc. that you have, you can actually make deductions, and after the deductions what you get is the resultant figure is called as gross total income, total income. Now we will come to the definition of who are all liable to pay taxes, that is persons, Vyaktigal ennu nammal parayunnu. So who are all responsible to pay taxes? It is defined as per section 231, which is called as person. Who is a person? It can be an individual, that is as we are all individuals, we are all assessed to tax. It can be a Hindu undivided family who are doing family business. Okay, the blood related Hindu religion, those who belong to the Hindu religion who do their family business are called as Hindu undivided family. Look at the term, it is Hindu undivided family, it is not divided. They are usually a united family who is carrying on the family business. It can be a company, that is a registered company. It can be a firm, that is partnership firms or association of persons or body of individuals etc. come under that particular category. You can have a local authority, that is your municipality, your corporation, they are also assessed to tax. Okay, you also have artificial judicial persons who are also liable to pay taxes. Now, all the people who are being assessed to tax under the assessment year are called as assessees. It is defined under section 27 of the Income Tax Act. Assessee is a person by whom tax or any other sum of money is payable under the particular act. Okay, so assessee is a particular person who is being assessed to tax, who is liable to pay tax. Even a particular person who is not paying taxes, if he is being assessed under, or if the income tax provisions are applicable on him, that particular person will also be called as an assessee. So in order to basically understand it very easily, it is very easy. Anybody on whom the provisions or the acts, the sections of income tax is applicable are all called as assessees. They will fall under the purview of assessee. Now there is another one concept which is called as a deemed assessee. Deemed assessee, if you look at the forefront, you will not find him as an assessee, but based upon the nature or characteristics or circumstances in which he indulges in various different activities, he would be defined or he would be called as a deemed assessee. An assessee not in real, but somebody who is a deemed assessee. So what is a deemed assessee? A person who is bound to pay tax in respect of the income of another one person. See, in this category, for example, a father, a mother and a child, for example. Child is a minor. The child cannot be assessed to tax because as of such, you all know from your business law, you know a minor cannot enter into a particular contract. Essentially, paying taxes is also a type of a contract whereby you contract yourself and you pay taxes to the government. A minor cannot enter into that particular contract. So what happens? Whatever income that particular child has, for example, let us take the example of a child artist who is acting in films or movies or serials, for example. That particular child would be earning income. Where does the income go to? It goes to the parent. So what income tax says is, in such circumstances, the parent will be called as a deemed assessee, though that particular income is not earned by the parent, but it is being earned by the child. Okay, so the parent is liable to pay taxes to the government, and in such circumstances the parent will be called the deemed assessee. Okay, where a person liable to comply with the legal requirements under the act fails to do so, he becomes an assessee in default. So there is another one term which is called as assessee in default. Default is person who is defaulting the provisions of the tax. So you have to pay taxes, you did not pay your tax. So the income tax will refer to you as an assessee in default. Again, there also you are called as an assessee. An assessee in default. So we have learned three terms here. One is assessee, deemed assessee, and the other one is the assessee in default. Okay, the assessee in default, simply known as failure to pay your taxes. Then you would be called as an assessee in default. Now, there is also a concept which is called as average rate of tax, which is there, the total taxes that you pay. If you look at the definition as per section 210, it will be tax on the total income divided by the total income during the previous year multiplied by 100. That is, you are trying to calculate the percentage of tax that you have paid in a particular year. It is simple mathematics whereby whatever is your tax that you pay divided by the total income multiplied by 100, you will get the tax. Why do you calculate this particular thing? Average rate of tax. It is to understand that on a percentage basis, what proportion of your income are you paying taxes? My income is so much, out of that what is the proportion of income tax that I am paying? So, in order to understand that, average rate of return or average rate of tax would be calculated. Now, there is something which is also called as the maximum marginal rate. As you all know, we are all paying taxes based on our levels of income. More the income, more will be the tax. So, there is a provision whereby it is called as a ceiling limit. Now, the government says you need to pay the maximum tax rate that is applicable in the country is 30%. So, that is called maximum marginal rate. That is also defined under section 229C, whereby your maximum tax is 30% plus education cess, that is health and education cess would be 4%. So, aggregate would be around 35.5%. Now, next which we will come into the next topic, which is also called as section 4 of the Income Tax Act, which is also called as residential status of individuals. Now, when you are born in a particular country, the birthright of that particular person gives him the citizenship in that particular country. Now, the income tax collects revenue or income tax collects taxes from people based upon the residential status, irrespective of whether you are a citizen in the country or not. So, that is called residential status. A particular person who is resident in India satisfying any one of the basic conditions. There are certain conditions which you have to satisfy in order to become a resident in the particular country. So, you would all be aware about the residential status which is there, residential status which you have compiled with. But residence, if you are a resident in India, irrespective of your citizen, that means even a foreigner can become a resident in the country. So, what is those basic conditions which are there? There are 3 different types of status which a particular person can take. One is being a resident, being an ordinarily resident, then being a not ordinarily resident, and also which is called as a non-resident. So, basically 3 criteria which you can take, which is there. Similarly, also you will find the residential status of people in the Hindu undivided family also. The Hindu undivided family can also take the residential status which is there. They can become resident as well as non-resident. In the case, we will come in detail with respect to that. You also have residency status of firms as well as AOPs. Residential status of firms and AOPs, they can be resident as well as non-resident, which is there. Residential status of companies is also the same, whereby they can become resident as well as non-resident companies, which is there. Okay. Next topic which is there is incomes which are exempt from tax. You know, there are you are liable to pay taxes on all the income that you have, but based on certain preferences which the governments have said that you need not pay tax for certain excluded classes of income. What are that? That are governed under section 10 of the Income Tax Act. One is agricultural income, fully exempt in India. Why? Because agriculture is a priority sector which the government has said, and all people belonging to that particular section need not pay tax on the agricultural income that they derive in the country. So, the government has given preference to that particular sector which is there. Next is receipt by a member from HUF. See, that is not actually exempted because HUF as of such is a separate assessee. HUF is already paying tax. So, the member who is deriving income from the HUF need not pay tax again. We do not have the provisions of double taxation. That is why it is exempted in the hands of the individual who is collecting tax. Next is the share of the partner in the profits of the firm. A partner who is deriving share of his profits from the firm will also be exempted, basically because the firm is paying the tax. Then interest on saving certificates, that is national saving certificates, etc. are exempted because government is promoting people to invest in various different savings. Then you also have the provisions which is some of the examples, I have just put in certain examples here. Leave travel concession, people who are eligible, salaried class who are eligible to take leave travel concession. They can travel along with their family once in 4 years, taken twice at a time. Then you also have interest income of non-resident. In order to promote people from outside India to invest into the country, government has given certain provisions whereby they can make investments, and whatever interest that they derive from their investments are tax free. So these are interest income from I will end with this particular module, module 1. Okay, we'll just recap on that particular module which is there. So the first one, what is actually income tax? It is a compulsory levy on the gross total income, taxpayers, which is there. What are the objectives which are there? Objectives of taxation? It's generation of revenue needed for the government, prevention of concentration of money in the hands of a few. It helps in the increase in the habits of savings and productive investments by the people, speedy economic development and generation of employment opportunities. Okay.